Hey guys, welcome to the Silver Report Uncut. If you haven't, be sure to follow our Telegram channel. It's t.me/Silver Report. What I think a lot of people fail to realize is moving forward, the Federal Reserve does not have the capacity to save the economy right now. And the real problem is that they've dug themselves a massive hole, and there's no way out of it. I wanted to go over what Bill Dudley, the former Fed president, was saying. He said, quote, "One thing is certain. To be effective, the Fed will have to inflict more losses on stock and bond investors than it has so far." And so over the years, this really has developed. When it first started out, they were able to adjust interest rates to be able to make an impact in the economy. That stopped working after a while. In 2008, through that financial crisis, they went into quantitative easing. It was a massive amount of dollars that they created. The Fed says that they created digitally, and they had to push it into the economy. And it temporarily worked. It helped to prop up the assets in the stock market. It helped to prop up the home prices. And it helped to save the Fed from looking like a total failure. And so the world's developed market central banks adopted the U.S. policy in recent decades. It's now a global phenomenon. Dudley said, quote, "This would mean hiking the federal funds rate considerably higher than currently anticipated. One way or another, to get inflation under control, the Fed will need to push bond yields high and stock prices lower. But cooling an overheated, capacity-constrained, hyper-financialized economy in a time that the whole world is struggling to get enough food, it seems like a complex problem. They've used up all the tools in their toolkit. Back when the U.S. economy had less debt and leverage, when financial assets had lower valuations, and when wealth was less concentrated, the ups and downs of the real economy drove the financial markets. In such a world, the Fed had much more control and used the conventional rate policies to influence behaviors and achieve their objectives. When that became less effective, then they moved in with these unconventional policies. That pushed us on to this hyper-financialized world. With such high levels of debt, leverage, and valuations, it is the financial markets that drive the real economy now. That's why the Federal Reserve cannot back out. Jerome Powell, when they were beginning quantitative easing, he made a couple statements saying that we will never be able to end this because anytime the market throws a tantrum, we're going to have to begin once again. And they're proving that to be true right now, or at least they will in around 6 months when they're easing. Things have changed. They're totally reversed. We now have experienced a modern economic cycle that looks nothing like this. We've never been through anything like this. When you look back on the 1970s, you find 3 distinct inflationary cycles. Inflation first peaked in 1970 at just over 6% and then backed off. It peaked again in 1975 at around 12%. It declined, but then it made a final push to nearly 15% in 1980. Well, in the third cycle, inflation went up and equities did too. But in the first 2 cycles, equities fell when inflation rose, and it rose when inflation fell. But to think that the Fed suddenly will gain the power, gain the ability to stop the devastation happening in our economy, it's never going to happen. They're never going to be able to find the tools because what are they going to do to help the stock market? They're going to need to bring down the stock market. And as they do that, people will panic. They'll be upset. Where is this money going to go? Really wealthy people cannot just keep their money in cash. Bonds, they're no sure thing these days. So where are they going to park all this money? That's why I think that the move in precious metals has not even begun. The move for gold and silver, it's not even awakened yet, and definitely for gold miners. If you guys invested in them from hearing about them here, you don't need to say thank you, but they have been performing very, very well. They're one of the best performing gold mines out there by far. Gold Mining Inc. continues to lead the gold mining stocks in terms of performance, and it just hit a fresh 52-week high. The management team there is doing so many things, including a major progress on their Alaskan project. But just in 2022 alone, Gold Mining Inc., it's up nearly 35%. And this was all happening while general markets were in a full-blown meltdown. In 2022, the Federal Reserve has promised not 1, not 2, but 3 rate hikes. And Wall Street's behavior, especially with all of this chaos going on in the second half of the year, will be risk-off. Gold is the ultimate risk-off asset class. That's in my view, personally. And within this sector, only one company strikes me as the most compelling example of a deep and extreme value setup at this very moment. Here's how the stock performed when gold's spot price rose in the past decade. Between December 2013 and March 2014, this stock rose 164% compared to the gold spot price, which rose 11.49%. That's over 10x leverage. Between January 2016 and September 2016, it rose 665%. compared to the spot price of gold, which rose 22.65%. So that's 30x leverage. In December 2018 to February 2020, it rose 150% compared to the spot price of gold, which rose 26.01%. That was 5 times leverage. From March 2020 to August 2020, it rose 218% compared to the spot price of gold at 36.12%. That's 7x leverage. At this very moment, Gold Mining Inc.'s gold resources, they trade for around $2.60 an ounce. That's $2.60 per ounce of gold. The industry standard is currently between $40 to $50 per ounce. And given its portfolio size, had the market given it the price of only $20 per ounce, half of the more conservative average, the stock would appreciate by 310%. So it's significantly undervalued. This is what you call in the mining industry a steal. Make sure to give your due diligence to Gold Mining Inc. It trades on the New York Stock Exchange under GLDG and on the TSX as GOLD, gold. Now, for its 32 million ounces of gold equivalent resources, the market is currently giving those a value of $84 million, or, as I said, $2.60 an ounce, nearly 94% below the industry standard of $40 an ounce. This is a stock that ought to trade at a premium since it's delivered leveraged returns compared with gold's price in all of its rallies in the past decade. Yet the stock price is exactly the same as it was in 2011. Analysts have tracked this company for years, and they give it price targets between Canadian $5 and US dollars $6, which implies a 400% upside from today's price. H.C. Wainwright & Company, they rated it at buy on August 30th, 2021. There's no other junior mining company that owns an equity position in a royalty company worth $100 million by itself. There is no other junior company that owns 32 million ounces of gold resources. And there are very few gold companies whose price targets issued by an institutional analyst imply a 400% upside appreciation potential. But we believe gold is about to experience an epic year. During times of rate hikes, investors are especially cautious until they see how higher rates impact stock and real estate. But the one historical factor no one can refute is how gold behaves in times of liftoff in interest rates. It gains, and it gains big. When Federal Reserve raises rates, gold appreciates 100% of the time. During the last 5 rate hike cycles, gold averaged nearly 200% in appreciation. From February 1972 to December 1974, gold soared from $48 an ounce to over $180 an ounce. That was a move of 280%. From January 1977 to April 1980, gold jumped from $130 an ounce to $850 an ounce. That was an epic move and a 540% slam dunk. From May 2004 to July 2006, gold, it roared upwards by around 90%. But in 2022, because of numerous standalone, non-repeatable, and unique catalysts, Gold Mining Inc. could be entering its most significant year since its formation. When Gold Mining Inc.'s largest shareholder, Admir Adnani, he formulated the idea to purchase gold resources in the ground at depths of the bear market. He was able to make acquisitions at 10 cents on the dollar. The combined market cap of the companies whose projects were acquired was $850 million. Yet Gold Mining Inc.'s shareholders paid only $81 million for them. The reason I'm telling you that Gold Mining Inc. is trading at some of the cheapest valuations in its 10-year corporate history right now is that the São Jorge project in Brazil, it was worth $150 million on its own in the 2011 bull market. It's nearly equal to Gold Mining Inc.'s market cap today. Yet the company owns 15 projects, not just one. So with 32 million ounces of gold equivalent resources, 16 million in the M&I category and 16.2 million inferred, the market is now trading these resources of $2.60 per ounce of gold, and if Gold Mining's management searches for a new project today, it would have to pay $40 to $50 per ounce. That means that buying shares in Gold Mining Inc. gives one access to gold ounces at a 95% discount to the average transaction in 2021. With shareholders such as BlackRock and Sprott Global, KCR Fund, if you're unaware of who they are, they essentially run the whole space of mining. BlackRock is one of the largest companies out there, and they have been directing the Fed's purchases, and they are a major investor. The KCR Fund is Katusa, Casey, and Rick Rule, the GDXJ ETF, Oppenheimer Holdings. This isn't like any other junior miner. And I say that because more than half of its current market cap is its equity position in GROY, one of the fastest growing royalty stocks in the world, worth more than the $100 million that they own. But there's a reason I point out these companies, and you could tell if you've been an investor, you've seen the performance yourself. I don't present anything on this channel that I don't believe in. Well, if you want to learn more about this company, you can simply visit their website at goldmining.com. It trades on the TSX under Gold and the New York Stock Exchange under GLDG. I thank you guys for stopping by and joining us. As always, stay free.